So, Lee, we've had a rate cut. Now
We
there's a
did.
debate. Should you cut rates? It's always the same. Should you cut them or shouldn't you cut them? Mixed with the fact that the president may have de facto control over the Fed fairly soon. And he's going to add something to the mix if he gets in there. And that is just we're going to cut rates to help the economy and make everything boom. Whether that's makes sense or not, I don't know. But if they get a hold of it, rates are going to drop rapidly fast. So,
Yeah, and most of the people on Wall Street, it's the same hedge. It's like, well, they have to be careful because of inflation, and that's true. But like we've discussed, inflation's kind of locked in 2.7, 2.8, in that range, and we still have the highest central bank rates of any G10 country,
yep.
and I think you're exactly right. I think Goldman Sachs thinks two more this year in October and December of 25 basis points each, and then they think another 50 basis points next year, ending in June of 2026, and that would take the base Fed funds rate down to 3 to 3.25. So the median rate at that level would be 3 1/8 or 3.125, and that will have a substantial impact on the nation, the home building. But most importantly, we have like 9 trillion of debt coming due, or some huge number that they have to. If they can redo that debt at lower interest rates,
Oh,
that'll
sure, sure.
take their
Listen,
burden down, and that's one of the
well,
big things the president's thinking about.
there's another part to this, and that is I understand it could have other effects on the economy. But if you look at the housing market, this is the one thing that could unlock it.
Yeah, yeah. Well, we're not going to see the 2.75 mortgage again.
No, no,
And
no, no.
if
But I'm
you,
saying people were like sticker shocked at 7%.
oh,
I
absolutely.
mean, it's not going to go that low, but even if it went to 4, I think it would unlock a huge amount of the housing market.
Well, if you chopped off, remember it's usually based on the 10-year yield anyway.
Yeah,
It's not really
I
based on
know.
funds. I mean, the Fed funds going down helps banks more than anybody, because then they can offer loans at a certain level, and they're getting their cost of capital down to 3 to 3.125, and so it benefits them the most. But yeah, I think that they'll probably go in October, and then that gives them another 60 days before the end of the year in the
Yeah.
last Fed meeting in December. So, if they cut another 25, and they were some on Wall Street were going, oh, it's going to be 50 basis points. It could be bigger. They're not going to do that. Powell's not going to do that. But I think they could stay on a course. And if they do, it would
Yeah.
be positive for the economy as a whole.
Yeah.